Hello, everyone. Welcome to our workshop on FinTech and impacts on financial markets. My name is Nihad Aliyev, and I'm joining you from Australia, Macquarie University and Digital Finance CRC. And I will be the moderator of this session. The speakers, one of the speakers is joining from Edinburgh, University of Edinburgh, Khaled-Din Rizaev. So Khaled-Din is a graduate from a PhD graduate from University of Edinburgh, and he's been an academic in University of Edinburgh and Koç University in Turkey, and he has been publishing in top finance journals. So I think he will have something useful to say on fintech and impacts on financial markets. So another speaker that we have today for you guys is Inci Allahverdieva, joining us from University of Technology, Sydney. So Inci is a researcher at University of Technology, Sydney, specialized in fraud detection in financial markets. And she has been researching on cryptocurrencies and scams on cryptocurrencies. So the agenda for today for us is I will be talking about briefly about origins of fintech. So I don't want to take too much time of my speakers. So then I will hand out to Khaled-Din and Inci to discuss different aspects of fintech. So Khaled-Din will discuss fintech and dimensions and implications of fintech, looking at fintech from broader view. And then Inci will go deep down on dark side of fintech, trying to discuss scams on cryptocurrencies, and then discuss implications for broader markets and what does that mean. And then at the end, if there are some times left, I will be discussing some recent trends in markets and trying to basically wrap up the whole topic. And after that, we will be having questions and answers, and whatever you feel like for us to answer, feel free to ask questions. And it doesn't have to be just on fintech, and we're all specialized in finance and financial markets, so you can be a bit broader than just fintech for today. So let me briefly define fintech so that we're all on the same page. So fintech is basically the business of using technology to offer financial services in new and better ways. So the definition speaks for itself. So it's just the innovative applications of technologies in the area of financial services. Okay, and financial services you can think of from a broader view, like banking, from financial advice to crowdfunding to whatever you think of related to finance. So offering innovative applications and technologies to solve financial problems is the area of fintech. And it generally takes place in three main types of organizations. So when we talk about fintech, we generally think about it as a startup thing, but it's not really just startups doing fintech, right? So fintech startups is part of the fintech ecosystem, but there is also big tech, which is a big part of the fintech ecosystem, right? So big tech like Google and Apple, they are also in this space that you should think of. And also incumbent financial services like banks, they're also losing some shares to this big tech and fintech startups, so they're also in the game. So it's basically a dynamics between these three types of organizations that shapes up the ecosystem of fintech. But I want to get you back to a bit to the history of fintech, so where it starts and why we can discuss fintech before we actually discuss different dimensions of fintech, right? So we should look at fintech from two factors, from two sides. One is the supply side, and the other one is the demand side. Okay, so that's effectively will tell us why we are having this workshop today. So the main reason that we have fintech is basically the first one is the computational power. Okay, without computational power, there is no fintech. There is not even a tech, let alone fintech, right? So increasing computational power as a primary driver of technological advancements over the past 60 years. And it's the reason why we have thin phones and relatively inexpensive phones, okay? And back in 1950s, Gordon Moore predicted that the number of transistors in circuits will double roughly over 2 years, and his predictions came roughly right. Okay, so the number of transistors in circuits has increased over time, and it's the reason why we can do heavy calculations in using our phone and computers and so on and so forth. So I'm not a computer scientist. I don't really understand when Gordon Moore predicted that transistors trying to fit those two circuits, but I understand that without the computational power, there is no FinTech. So that's the first aspect that enables us to have FinTech. The second aspect is that the data collection and storage. So that's also a very big part of the FinTech. So back in 1959, so the first storage was 2 megabytes, and that's at the moment, that is for us, it's just nothing. So at the moment we're talking about zettabytes, and it's in 2020 we had 47 zettabytes of data stored, and it's expected that in 2025 it's zettabyte. For you to understand what zettabyte is, it's just 10 to the power of 20 something bytes. Okay, so in simple words, it's a lot. And without this data collection and data storage, there is no FinTech. And the third one is internet, and which is the big one, right? So the connectivity, again, back in 1969. So the first message sent from UCLA to UCSB and Utah and SRI was login, and they couldn't even send the word message login. They only were able to send log, L and O, okay? So, and at the moment, we have 6G, okay? And that evolved from 2G, 3G, 4G, 5G, and 6G. And all these three factors effectively enable us to discuss FinTech. Computational power, data collection, and connectivity. That's happening on the supply side. On the demand side, so only supply side is not enough, right? So there has to be demand side too for the FinTech too. So on the demand side, the first factor is changing customer expectations. So customers today are basically demand for convenience. They want efficiency, they want transparency, they want personalized experience, and we are used to it. So we are impatient. So we have high expectations from the services that we receive. So that changing customer expectations effectively is a demand factor of FinTech. The second one is FinTech's value. FinTech companies have emerged as a bridge effectively between innovative tech firms and user-centric financial solutions. So when it started, it was a gap filling between tech and finance, but it's now a big ecosystem. And also there was unmet needs by the financial services. So people were not happy the way the banks were operating or the way other traditional financial institutions were operating. So there were too much unmet needs. So that's why it created an area or a demand factor for FinTech. And the last one is adoption, right? So it's very important. So in theory, adoption of a technology is very important because adoption brings adoption. So the fact that my friend uses some technology increase my utility of using that technology too. So that's a simple network effect 101 economics course, where basically we learn that if there is adoption, more adoption will come. So effectively, you have this snowball effect that enabled FinTech to grow. Okay, so that's all I want to say. But I wanted to make sure that we are on the same page when what we mean by FinTech and why we are discussing this FinTech today and what's the origin of it, right? So now I want to hand it out to Kaladin to discuss a broader view of FinTech and what it means for markets. Thanks.
Thank you, Nihat. Thank you for great introduction. So let me share my screen. Can you see my screen?
Yes.
That's great. Thank you, Nihat. So again, thanks, Nihat, for the introduction. And FinTech is indeed a great interest. So everyone is interested in FinTech, and I will briefly cover its dimensions and some implications and applications today. And I'm Kaladin. As Nihat introduced, I am affiliated with the University of Edinburgh and Koç University. I also work with the London School of Economics as well. And so what I want today is like to go kind of over important questions like what is fintech? Why do we need to know about fintech? And kind of a bit historical evolution of fintech as well. So I guess it's pretty obvious from name. What is fintech? It's intersection between finance and technology. So our main aim here is the introduction of new and advanced technologies into the financial sector, because we know that I will briefly talk today as well. Later on, financial markets continuously use new technology, and that's the reason that I believe when we have new technology, using this in finance is kind of inevitable. And this intersection is fintech that we have seen so far. But why it is important? Yes, I mean the when we check some statistics, we realize that since 2014, we start to see more and more fintech in our daily life. That's a Google Trends data. It shows interest over time. When you search specific keyword on Google, Google kind of produce trend chart for you, gives you trend data. And since 2014, we see that there's a huge increment, kind of sharp increments over fintech search. And so this clearly shows the general public interest in fintech. But obviously it's not enough, yes, because that's a general interest. It's fun. That's great. But what about kind of at a more professional level? We can see that it's not about the public interest only. When we check the investment amount, we see that global venture capital investment in fintech applications increased massively. Since 2011, it increased by more than 15 times. That's a clear sign of huge adoption, as Nihat mentioned briefly in his talk. And we don't see this at the investment level only. Obviously, when we check country level statistics, we see that all countries are interested in fintech adoption. And average adoption is about 33%. And in some countries, it's quite high. Like in China, for instance, it's about 70%. And overall, we see that India, emerging countries like China, India, Brazil, and also highly developed countries like UK, Australia, US, Spain, Germany, adopting fintech at a very high pace. Okay, but what about us? Yes, what about kind of our students? What about like let me put it that way, relatively younger generation? What we see is that we have a lot of avenues for fintech jobs. If you have enough knowledge in fintech, you can work at advisor firms, fintech startups, traditional financial institutions, and all their avenues. Okay, and we see that from statistics too. We know that we will see a lot of job cuts, especially now, given very high inflation in many countries. What we expect is that there will be switch from traditional banking jobs to fintech jobs, and we see that information from news as well. For instance, that's Financial Times news, which predicts that there will be growth in fintech, which will basically cut 2 million banking jobs, and this job will switch to fintech applications and new fintech companies. And also, that information is from the UK, given that I work closely with the UK. And we see that London and in the whole UK, there is a sharp increments in hiring in fintech. So when we compare the hiring in fintech with other industries, we see that there's a clear jump in fintech rather than other industries. And vacancy growth is about 61% in London, which is expected. It is one of the biggest financial centers, but in other regions as well. So overall, as I said, that's very clear cut for us that we see all this switch. So a lot of jobs will be there, and a lot of investments will be there as well. So the natural question is, why now? Yes. So as I said, fintech is the intersection between finance and technology. But the interesting question here is it new? I don't think so. We know that financial industry has historically been an early adopters of new technologies. We have always used new technology in finance, like telephone telegrams, like computers, now cloud computing, machine learning, and all of it. But What we see is that we see this jump after 2014. Why? So that's a natural question that we need to answer. Before answering that, I would like to show you some historical examples of fintech applications. For instance, ATM. So it was June 1967 when we see the first ATM in the world. It was in London, and on 27th of June. And about 6 years ago, it was its 50th birthday. So that golden one here is the first ATM machine in the world. It turns to gold on 50th birthday. So we have this since 2067. And yes, we have now a lot of extensions like not, let's say, the traditional ATMs, like Bitcoin ATMs, all of it. But still, it's like, as I said, we have this technology since 1967. In addition to this, I would like to show you some other examples as well. For instance, credit cards. That's a Diner Spaceman credit card. It's the first credit card in the world. It was invented in the US. And we also have different like effects of internet in finance. We had like internet shopping, which increased massively. And we have online finance portals like Bloomberg.com. All of them, we know that we have them since the 1960s, since the 1970s. Okay, but what are the unique sites then? As I said, the most important question here is why do we need to learn about fintech now? So because of three main reasons. The first reason is the pace of technological change. So we had, as I said, if we go back like first ATM, if we take this as a starting point, from first ATM to 1990s, we see a little bit gradual change. But after 2000, we see sharp increments. We see a lot of applications, a lot of fintech startups, all of them now in our lives. And the impact of technological change now is very massive. So initially, when we had this technology in finance, only big banks, financial institutions were using that technologies. But now all of us, like we have our phones, that we can literally do everything with our phones. And the most important one, which is the red here, is the drivers of technological change. What I mean here is previously the technological change were proposed and implemented by financial sector, as I said, ATM. Yeah, so the Barclays was the first bank that thought about this and said, okay, let's use that. But now it's quite different. It's proposed by young startups and big established companies. Yes, we have Google, we have Amazon, we have Apple. All of these companies bring new doors of competition. This changed the shape of adoption of fintech. Yes, we can kind of think about the four main factors here. One, we have a huge venture capital. Second, as I said, interest of giant tech players. Third, we have a bit more supportive regulations. This is a bit debatable because we still think about this. Some countries are open, some countries are not, and some countries try to kind of think twice before making any regulatory change due to fintech. And the last one is young people interest. Okay, I would say even love for technology. So it changed significantly, and we love technology. As we use, as I said, phones, computers, and that's the reason that drive today's fintech. So that's the dimensions of fintech that we have. As I said, while we have technology since 1977, before that, we see increment in fintech adoption after 2000s, and that's the reason that we have this session. Yes. But what about fintech applications? What do we mean when we say fintech? Yes, we keep hearing about fintech, but what does this exactly mean? I would like to briefly cover main applications here. One is blockchain. It is decentralized ledger, and so we have we can think about these two main keywords here, like block and chain. We have storage of information, and chain allow us to link these blocks to each other. And all of us, I would say, I don't know whether Nihat and Inji would agree with me, but I would say that it's a bit unfortunate that we know when we say blockchain, especially young generation think about only cryptocurrencies. So because we know blockchain because of Bitcoin, yes. So, but the important thing here is that blockchain has amazing applications that can indeed change the world. Like for instance, supply and chain systems. Or we can use smart contracts. Yes, it means that all recordings can be used by using can be done by using blockchain. Okay, so and that's the main applications, sub applications that we can have by using blockchain. You can even vote by using blockchain. Yeah, so you can have like health system. One example that I always use, I did my PhD at the University of Edinburgh, and then I moved to London to do my postdoc. England and Scotland have different health systems. When I moved from Scotland to England, and I had some health recourse that I wanted to have, I went to the GP, let's say general practice, and they couldn't find my record because the Scotland and England have different health systems. The blockchain can allow us to have one global health system, which means that if you go hospital in Azerbaijan, let's say, and later on you change your country, you can still find your records. Yeah, so that's kind of fascinating things that we need to think a lot. And so that's the main sub applications of blockchain. And cryptocurrency here is, as I said, that's the biggest one. We see a lot. We heard news a lot about Bitcoin, Ethereum, all of it, and we see that we have again, sharp increments in the number of blockchain wallet users. These are mainly active users that send information of Bitcoin to each other. And we see that people are keep investing, keep using blockchain. And another big application is big data and machine learning. So it's a branch of AI. That's what we can think about this. It works with minimal human intervention. When we have reinforcement learning, we can even work almost no human intervention. So it's used by almost all giant companies like YouTube, Netflix. All of these companies are actively using big data and machine learning. And we see that if we again check Google Trend data, we see that, yes, so everyone is interested in big data and machine learning. But that's not stays there only. We see a lot of change. For instance, that is the importance of big data by industry. So this blue line basically shows, blue columns here, color shows that it's critical for technology, for instance, for telecommunication, advertising, insurance, for all of these industries, like even education, government, and all of these. We see that that's important. That's either very important or crucial. So we need to use big data. And when we ask companies, we indeed get the same news, same information, that executives of companies like CEO, chairmen, they really believe that big data change everything. It enhances the performance, optimize internal business operations. It allows executives to make better decisions, and all of it. Okay, and so in an academy, we see that trend as well, that we have increase in AI and big data papers. Algorithmic trading that I would like to briefly mention, that's directly my research interest. It's kind of computers make decision on behalf of traders. But it's not electronic trading. In electronic trading, you make decision and then computer trade for you. But now computers can make decision as well. And the more specialized version of it is high frequency traders. It is they work like at a very high speed. So think about this way. I want to show that map to you. This map shows the information transmission lines between Frankfurt and London. That's the microwave lines. And through that microwave lines, information transmission speed is about 2.4, 2.3 millisecond. And the theoretical limit, which is speed of light, is about 2.1, 2.2 millisecond between these 2 points. So we're on the edge of the limit. That's how financial markets are specialized now. And when we check the statistics, we see that on average, 50% of the US equities daily volume are traded by high-frequency traders. Effectively, it means 1 out of 2 shares are traded by HFTs, high-frequency traders. Okay, and I have a nice video here, which I will not present, but if anyone interested in, I hope the moderator and administrators can share our emails. You can get in touch with me. And another application is fintech banks. Revolut, I think now it is used in Azerbaijan as well, as far as I know. So they are offering the same service offered by traditional banks. And their marketing is that traditional banks focus on products, but we focus on customers. care more about customers rather than our products. And we see it's quite interesting. It works slightly, yes, not slightly, I would say. For instance, Monzo, Starling, all of these two banks, the first and second banks, are fintech banks, and Nationwide until HSBC, all other banks are like traditional banks. We see that all traditional banks except Nationwide and HSBC are losing customers, but Monzo and Starling gaining customers. It clearly shows that people have interest in them. And I use personally Monzo and Revolut. It's quite friendly. The interface is quite friendly that you can easily use. You can do whatever you want. And you don't need to go to kind of the building, let me put it that way, to bank branch to say anything. I know it's a bit concern as well. When you put your deposit into bank account, you won't see that building, yeah? So because if you have any problem, you can go to that building. They don't have that buildings. But yeah, you can do everything by using just one app. So that's clear technological change that we have. And also we have crowdfunding and other applications. Crowdfunding simply means that people get money from the crowd. And we see a lot of peer-to-peer consumer lending. All of it, we have kind of huge increments. So I want to kind of go to the end. We have a lot of other applications like mobile payments, like insurance, fintech insurance, which is insurtech. By the way, there is a nice trend in insurance that I would like to mention. It's quite different from other fintech applications. In an insurance industry, it works quite interestingly in a way that when we have small insurance companies, big companies are buying them, are merging with them. And this is kind of interesting trend that we don't know what will happen at the end, but it's kind of, as I said, interesting. So for instance, the global insurance accelerators on the left, you see it merged with all these small companies like ISCEMR, like telematics.com, all of these companies. As I said, we had other applications as well. So in the last part, just 1 minute, I would like to briefly mention that COVID-19 pandemic changed the fintech adoption massively. So we see that digital financial inclusion could play an important role. We saw it during COVID-19 crisis, and everyone started to use fintech applications during COVID. The application downloads, fintech adoption, all of these statistics doubled, tripled during COVID-19. And what we expect is that at some point, fintech will become synonyms with financial services around the world. So we will have just fintech, not financial services. That is, for me, I believe that is inevitable. Thank you.
An excellent review of fintech applications. Now I will hand out to Ingi to go a bit deeper. So now we have a broader overview of what the fintech is and what it's used for and what the trends are. Now we're going to go a bit deeper, right? So we don't want just to understand the good side of fintech, but we also want to understand the bad side of fintech too. So now I'll give it to Ingi to go a bit to dark side of fintech. Thanks.
Thank you, Nihat. Hi, everyone, again. My name is Ingi, and I'm a researcher at University of Technology, Sydney, and specialized in forensic data analysis. Again, thank you, Nihat, for great introduction, and also thank you, Khaled, for a nice and brief explanation of fintech. Let me share my screen first, and then quickly start the presentation. Yeah. Okay, just checking. Can you see my screen?
Yes.
Okay. So today I will discuss one of the hot topic of recent years, cryptocurrencies, but specifically I will focus on the dark side of cryptocurrencies. So I think everyone can agree with me that the cryptocurrencies revolutionized how we perceive and interact with money. but it also opens the gates for scammers. So today we will focus on this dark side of cryptocurrencies to show the scale of the problem. So according to the 2021 crypto crime report of chain analysis, over 7.7 billion worth of cryptocurrency have been stolen from the victims worldwide. And this represents 85% increase compared to the 2020. And it believed that this increase is mainly associated with the emergence of new type of scams, which is called rug pulls, today's discussion is also mainly will be around this type of rug pulls. Shortly, I will explain what are they. So there are some interesting questions like how are cryptocurrency scams formed? And what is the scale of those scams like, and how they evolve over time? And what characteristics can distinguish between scam tokens and normal tokens? And also, are there some type of characteristics that can help us to prevent from the scams? But before diving into more detail, I would like, considering the people in the audience who do not have idea about the blockchain, actually, Kalatin already gave some high level of idea about the blockchain, but let me just briefly explain it, maybe a bit more. So blockchain is a system of storing and transferring the information in a distributed and decentralized way. So let's break down a little bit. What type of information? It's a blockchain-specific information, and Kalatin also mentioned list of all the blockchain applications. But I would like you to think about, for now, focus on the transaction information. So person A sends $100 to person B. Nihat sends $20 to Kalatin. Kalatin sends $80 to Inji. Like all this type of transaction information. And so you can think of a blockchain as a one digital ledger or one big record book. It's a digital. Everyone have access on it. And that is why it is distributed. And everyone can update it. What does it mean? Everyone can add the information. Like, let's say this transaction information, every time you transact, this is stored in the blockchain, in that ledger. So that is why this is distributed and decentralized. And once the information is validated, it's almost impossible, and it also can be validated by the market participants, by you, by me. Like if I have a big computational power, I can validate that information. And once it's validated, no one can change it. So that is why it's quite secure. And if we compare it with the traditional market, which is centralized, so you can think about a bank. There is a single authority, which is bank, who control all these transaction information. Like all the clients have their own ledger with bank, and only bank can determine who can view or update the ledger. Even the bank can manipulate that ledger. So that's why it's centralized and controlled by one central authority. And about, in order to visualize how this blockchain work, let's think about block and chain, which is Kalatin also mentioned already. So in each block, you can think that the data is stored. And by saying data, it's again the transaction records and other blockchain specific information. So it can be someone sends money to someone else, or it can be your medical records. But now just let's focus on the transaction information. And each block has its own unique identifier, which is called hash. And each block is also have the hash of the previous block. So that is why they chronologically order it and they link to each other, and so they create a chain. Again, once each block is validated, no one can change it. So that's why they are quite secure. So transaction information is like Jasper sent $100 to Laura. Laura sent $25 to Brandon. And like, this is just one transaction, but think there are hundreds of transactions in each block. But it's not like as simple as this, like Laura and Brandon. You do not see the names. Like this is like a wallet addresses with the combination of letters and numbers. So it's quite anonymous. You just see the bunch of numbers and letters. It's anonymous. You don't know who are they. And so, for example, this is just a standard normal Bitcoin transfer. So Bitcoin is one of the example of the blockchain, and Bitcoin is the native token of its own blockchain. And this picture here is the blockchain transaction. One counterparty sent the Bitcoin to another, but it's more than that. So according to the US FBI allegation, this is a Bitcoin payment for a murder. So they prosecuted by the FBI. So they were a darknet marketplace, which was called Silk Road, which is seized in 2013 by US FBI. But this marketplace literally looks like eBay. Think about eBay and Amazon, but they sell all these illegal products, the drugs and also illegal services, like you can service to murder someone else, and all the payments are made by Bitcoin, but the persons look like these wallet addresses, like combination of letters and numbers. And one of my colleagues' paper in 2018 RFS paper, they found that 46% of all Bitcoin transactions, as well as 26% of users are illegal. So people use the Bitcoin transfer to do the illegal stuff. Now I would like to focus on the Ethereum blockchain, which is another type of blockchain, and the native token is Ethereum. And the main difference of Ethereum blockchain comparing to Bitcoin, Ethereum has a smart contract functionality. What is a smart contract? So it's a type of protocol that can self-execute with the terms of the agreement written in the contract code. So by using this contract, everyone can create their own token. So as hundreds of people can create hundreds of tokens every day. So that is why Ethereum creates a list of standards in order to standardize that process. There are many standards, but the majority of the tokens follows the ERC20, stands for Ethereum Request for Comments 20. And what is ERC20? So it specified a list of rules for each token. And these rules can include, for example, the total supply of the token, how the tokens are transferred, the name of the token, how the transactions will be approved. So everyone create their own token. Let's say I create my own token and name it Inji. And now I need a marketplace to exchange it, to trade it. So I need some place to sell it or buy it. So now automated market makers can help to do so. So automated market makers are agents that pool liquidity and make it available to the traders, but they are all according to the algorithm. So they are all coded. So let's see how this liquidity pools worked by automated market makers. So token creator creates a new token. Let's call it token A. And they pair it with another token. This token is usually a Versi token, which is previously created, and you can consider it Ethereum. So I create some token A and pair it with Ethereum, which has already had value on average, let's say $2,000 per one Ethereum or $3,000. And you pair it and add it to the liquidity pool. Now in the liquidity pool, you have some amount of token A and some amount of token B. And I want you to focus on token A because there is a probability that this token A is a scam token. So how we define the price of A? So the ratio of token A to B will be the price of token A, or in another word, we will call it swap rate. So once the pool creator add the liquidity, he or she will receive LP token in return. So this is the third token. And this LP token shows the share of pool creator on that liquidity pool. Once there is liquidity available in the pool, then another market participants, let's call them users, can interact with the pool through two main types of operations. So first type of operations is swapping operation. So they can exchange token A and token B. So they can send the token A to the pool and receive token B in return, or vice versa. If they buy token A, this will make the price of token A increase against token B, because the number of token B will increase in the pool. And another types of operations are adding liquidity, and its opposite is the removing liquidity. What is adding liquidity? So some other users can also add both token A and token B to the pool and receive LP token. And they can also withdraw their share. So now we have high level of understanding about this, how these liquidity pools work, and now how one can scam you. So as this B token is worthy, and usually the scam creators is the only owner of 100%, holds the 100% of LP, and this allows them to withdraw all the worthy token from the pool whenever they want. And once the price of A token increase, they withdraw all the B tokens and left the users with worthless A tokens. So there is no liquidity left in the pool. So that is why users won't be able to swap their tokens. So this specific type of a scam called rug pull. So rug pull involves a creator who attracts investors or users to a new token project, and then pulls out before the project is built and leaves investors with worthless token. There are two main types of rug pulls, soft and hard rug pull. And the major difference is hard rug pulls have the malicious code in their smart contract. So as I mentioned before, you can create your own token by using smart contracts, and when writing down the codes, you can use some malicious code. One of the famous malicious code, like once you create your pool, you can prevent the users to sell them. So they will buy token A, but later on, they won't be able to sell them because code will stop them, will block them. So this is a malicious code. And in the soft rug pull, this type of rug pulls do not have any problem with their smart contract. It's totally valid contracts, but the token creator built some trust, interact a lot of investors, like you may have seen some bloggers or some famous people doing marketing on some crypto projects. So the majority of them are scams actually. And so they build some trust, they use some famous people, and then steal all the liquidity from the pool. So as you can see, hard rug pulls a little bit easier to detect compared to soft rug pulls, because sorry. Before you can audit the smart contract and find out the malicious code, but with the soft rug pull, it's hard. So I would like to show you some case study about one of the soft rug pulls. So this is a token that is called Ukraine. As you know, after the Russia-Ukraine war, the people create a lot of Ukrainian token to donate to help the Ukraine, but there are also scammers as well. So token creator creates the Ukraine token, and from the graph, which is on the x-axis, you can see the hours, and on the y-axis, you can see the price of Ukraine token. Within the 40 hours of the creation, the price increased dramatically and then collapsed day after about 140 hours. And we call this as a price pattern. So we can observe a dramatic increase and then collapse. And in terms of creator profit, we can track the creator's wallet address, and we can see that creator gradually withdraw the Versi token from the liquidity pool. So remember, we call the Versi token B, and it was Ether in Ukrainian token case. So creator gradually withdraw Ether from the pool. And previously, when a creator starts the pool, he or she adds 20 WES, wrapped Ether or Ether, but then at the end, he or she able to withdraw 1,274 Ether. So creator basically end up with profit. And in terms of activity, we can see that there is no any activity happening currently in the pool because there is no liquidity left, so no one can trade against the pool. And in order to identify the scam, we obtain the hard rock pool list from the tokensniffer.com. This is a company. You can consider this is as a smart contract audit company. They audit the smart contracts and trying to detect the malicious codes. And we can identify around 2,400 rock pools. And we can see that around 1,800 of them have at least 5 transactions. And in terms of the time series evolution, we can see that towards the end of our sample, the number of rock pools decreased. And the reason behind because the smart contract audit companies increase in the market. Also, Ethereum platform itself also builds a smart contract audit, so it's getting difficult to deploy the smart contract with a problem, with a malicious code. So that's why the number decreased. But in terms of soft rug pools, we build the algorithm, as I show you in the case study, price, profit, and activity pattern. So price pattern was if there is a price run up and then collapse, and if the creator of the token ends up with profit, and if there is no activity in the pool, and if the given token satisfies all these conditions, we call them soft rug pools. And what we identify, 41% of all liquidity pools in major decentralized exchanges are soft rug pools, and this is quite large number. And 11% of them are economically meaningful. By saying economically meaningful, we identify that these pool creators steal more than 10,000 USD from the victims. And in terms of time series evolution, it's different from hard rug pool. We can see that there is an increase actually in the number of soft rug pools. As I said, it's hard to detect soft rug pool because it's all investors should do their research because they build by building the trust with investors. So it's quite hard to detect them. In terms of, as it's hard to detect the soft rug pools, to prevent the investors to getting scammed, in our research paper, we developed a lot of variables, characteristics that can distinguish between scam and non-scam tokens. And because of the time constraints, I would like just only focus on ex-ante characteristics. What does ex-ante characteristics mean? So once the token created at the same time, just in a second, you can get those characteristics. And those characteristics can tell you the probability of that the given token is scam. So what are those characteristics? It says token creator's experience, which is measured by how many tokens they previously interacted with and how many liquidity pools the creator previously interacted with. Imitation, this is quite interesting variable. What is imitation? Scam token creators usually imitate the famous tokens or the famous events. For example, this Ukraine token, there are hundreds of Ukraine tokens because of the Russian-Ukraine war. And also you can see hundreds of Bitcoin tokens, because inexperienced investors usually so sorry, let me take water and I'll come back.
Okay, maybe I can continue here because I'm also a co-author on this paper. So
I can continue.
Okay, go ahead, Inji.
Sorry, I think I was so excited while talking. Yeah, so for example, there are a lot of Bitcoin tokens, Ethereum tokens as well. So inexperienced users usually do not check the wallet addresses because they're quite long and difficult to identify the original ones. So that is why it's easy to scam the inexperienced users. And then the LP lock is also interesting variable. What is LP lock? As I said, once you create the pool, you receive LP, which shows your share in the pool. And this LP token give you the power to steal the liquidity. So that is why you should lock it to show the investors that you are not gonna steal the liquidity. And usually scam token creators do not lock them. And we build our index based on these characteristics. And I would like to show you the time series trend of our index. First, our index shows that out of 57 liquidity pools, around 36 of them have a scam index, have a scam probability of greater than 0.5. And looking at the time series trend, we can see that it starts from 20% and increase to as high as 70% towards the end of sample. And in terms of our contribution, our research project has several implications. So we determine list of characteristics of a scam pool, and they can serve as a red flag for investors when investing in a token. So they can use our characteristics in order to decide if the given token is a good token to invest or not. And on the other hand, our analysis also contribute reducing uncertainty regarding the scale of scamming activity. So for example, before our analysis, no one knows how many portion of the liquidity pools are scam, but we find that actually 41% of them are scams. So that is why this can help policymakers to make better informed decisions when evaluating the costs and benefits of blockchain. And also our detection algorithm, which contains 3 patterns, assists the law enforcement authorities in prosecuting scammers. And also our scam index is used for surveillance and to prevent the scams before they occur. So thank you for listening, and sorry for my voice. I'm happy to receive any type of questions.
Thanks, Inji. Ilkin will let us know if there is any question. In the meantime, I will zoom out now. So now we went all the way into dark side of FinTech and characterized the scams, showing that it's not all the rosy and good stuff happening in FinTech. And it also allows the misuse of technology, enables scammers. So for us as a researcher is basically to identify these loopholes and guide the platform developers or regulators in designing markets that works as efficient as possible so that this type of scamming activities are reduced and the investors' money are safe. Now I want to zoom out a bit. So let me share my screen. Okay. So now I want to get back to the markets, right? So one thing that we have been working on with Kaladin is basically recent trends in markets and whether that has something to do with technology evolution, right? So first thing is that how has the nature of liquidity in financial markets and its risk has changed through time, and what drives the changing nature of liquidity, right? So if there is any algorithmic trading, HFTs, or market fragmentation or dark trading, whether all this change in market structure or market participant actually lead to certain trends on liquidity, okay? So first, let me show you four striking figures, which was quite interesting when we first time saw it. It's basically, the first graph shows us the average relative spread. It's basically the difference between buying price and selling price. So generally in financial markets, we measure liquidity in different ways. And one of the easiest and straightforward ways is basically the difference between buying price and selling price. So if this gap between buying price and selling price is high, so that means market is not so liquid, okay? And what we see from the first figure here is that average spread has declined since 1996 up until to 2022. Average spread has declined. So that means market has been going in the right direction. All these technology revolutions has been making investors to better off, paying less spread when they buy and sell, okay? And then we look at the standard deviation of relative spread, and that's also going down all the way from 1996 to 2022. There are small spikes, like let's say during the GFC times or during the dot-com bubble, but that's expected because during the stress market period, so spread increases. But overall, we see that there is a declining trend on average spread and relative spread. But then when we look at the skewness and kurtosis of relative spread, where effectively the third moment and fourth moment of the distribution, so we see that skewness and relative spread has been increasing. What's happening is basically that average liquidity has improved over time, but the average can be deceiving. Okay, so from what we see from the skewness and kurtosis, effectively that means that the tail of liquidity shocks got worse. The market is more liquid, but at the same time, liquidity shocks are worse. So whenever shock happens, it is much worse than back in 1996, okay? And we want to understand this phenomenon, right? And whether that has something to do with technology. And we see the similar pattern on liquidity crashes. So here on the first figure, I plot the number of liquidity crashes. So obviously there's a big spike during the 2000-2002 period, which is the dot-com period. But overall, you see that there's an upward trend on the number of liquidity crashes in the markets. And then the magnitude of liquidity crashes, whenever spread moves, so it moves much higher these days compared to 1996 and early 2000s. Okay, so there is an increasing number and magnitude of liquid black holes as we see it. Okay, and then the question is, what is causing this? Here I just took the liquidity, right? So because in market microstructure, the specific field that Kaladin and me working on, we are very much interested in market liquidity and the market prices and the efficiency of it. And liquidity is very important for investors. So there are two main reasons. So the one is basically the change in market structure. So there is already evidence dating back to 2019 that HFT added with market fragmentation, it improves liquidity. So the fact that we have lots of algorithmic trading in the market, that improves liquidity, but at the same time, that increases the liquidity risk, okay? And the reason mainly is that these algorithmic tradings have correlations, correlated trading strategies. Whenever they're buying, they're all buying. Whenever they're selling, they're all selling, okay? And then why HFT can increase liquidity risk? One is basically the correlated trading strategies. The other is basically HFTs can look at markets at different times, different markets at the same time, and effectively that's what we call is price watching. So they watch the price of one asset in one market and then quickly trade on the other market at the blink of a time, and then that moves market and liquidity of the market a lot. Another explanation could be learning about adverse selection that we have proposed, me and my co-authors back in 2019. We proposed that effectively HFTs and all these new market participants learn about adverse selection risk in the market, and whenever they see that adverse selection risk increased, that increases the liquidity risk. And that's basically one in the market structure change explanation. But the other is basically is that the market participant, right? So the US markets, we know that, as Kaladin has shown, that it belongs to bots, not retail traders. As you can see from the second figure here, the quant traders are much higher than the discretionary traders. But that doesn't necessarily mean that we have higher quants now, or higher high frequency trader, or higher algorithmic trader. That means market is more efficient. For example, in another paper recently, me and some of my co-authors, we have shown that, but this is more like a theoretical paper as opposed to an empirical paper. What we are very interested in, whether increasing quant is always better for markets, and we show that that's not necessarily the case. So increasing quant doesn't necessarily mean that markets become more efficient, right? So this is still a hot topic, and we as a researcher, we're still working on it. We're trying to understand the recent trends in markets and whether that has something to do with technology revolutions in markets, HFTs and quant traders, and so on and so forth.
So one point that, Neil, I would like to mention there is, it's like if you are not doing research in microstructure, you may not get the point. What is the cost of it? Yes, so we need to put this into nice economic perspective. One example here is like flash crash, 2010 flash crash, 6th of May. So during that flash crash, for instance, the stock price and major index dropped by about 10% and rebounded back. So that was it's considered a $1 trillion of flash crash in the US market. So it's gone. So you lost this money. So it's like, imagine again, $1 trillion Turkish GDP is not $1 trillion. Yeah. So to put that into perspective, that kind of events, massive flash crash, are really, really important to understand. That's the reason that we are interested in this topic. That's what I want to stress out. Thanks, Nihat, again.
No worries. And that's what I was getting into, the real effects, right? So we want to understand the real effects of HFTs. So in 2003, there was this event in New York Stock Exchange called AutoQuote, which is basically AutoQuote replaced manual dissemination of inside quote by specialists with a new automated quote. What does that mean? Is basically that now, in 2002, there wasn't many algorithmic traders. Now in 2004, there are lots of algorithmic trader and HFTs because of this policy reform in New York Stock Exchange. And we use this as a natural experiment in one of our paper with Kaladin, and show that algorithmic traders and HFTs, due to their improvement in spread, we show that they have improved the average spread, they contribute to managerial learning. I will briefly explain what the managerial learning is, but I want to get that into perspective from the perspective of gains from trade, right? So you can see that the spread on the left-hand side has declined, and you can see that from 2002 to 2004, there is a huge difference on the spread, but there is also a huge increase in volume. Okay, what that means is basically due to spread reduction, the volume has increased in the market. Now there are more people in the market because they are paying less cost, because the spread is the cost to investor. Okay, and we can easily see that there is this welfare impact of this improvement in liquidity. Okay, so this can be easily illustrated from the supply and demand curve that we learned from the economics. So say currently the price that the investor is paying for buying V1 volume is P, some efficient price, plus spread divided by 2. So I'm just looking at the buyer side here. Okay, so what that means is that this bit, the green part, is a surplus to buyers. So the buyers has value above this price, and they pay this price, P plus S1 divided by 2. Right? So that green part is an economic surplus or consumer surplus that we call in economics. But then think like spread has declined, as you can see in AutoQuote. Due to the spread decline, now volume has increased, right? And there is an exact immediate welfare implication of this, because now there is a surplus to initial buyers. Now this bit red part is a surplus, additional surplus to initial buyers. But there is also this blue triangle here, which is the new buyers, because previously they were not in the market. Now they are in the market. So this effectively increases consumer surplus from this small green triangle here, added to the red rectangle and also the blue triangle here. Okay, and a similar effect is happening on the seller side. And if you look at the supply curve, initially the sellers were getting only this green bit, but then when the spread declined, there is also a red bit and the blue bit. Okay, so that's an additional producer surplus that they are getting in. Okay, and this bit is basically the yellow part is going to the liquidity suppliers, or the people who are providing liquidity to the market. But what's interesting in this small triangle here, which is a deadweight loss. Okay, because of that spread, we have got a deadweight loss here. Previously, that deadweight loss was this big triangle because the spread was S1. But now it's a small triangle because spread has improved. So whenever spread improves, we are interested in that because that means there is a new volume coming to the market, there is a new people coming to the market, there is a new surplus to the consumers and producers, right? So in one of our research, we're trying to basically see what this additional surplus is to consumers and producers because of the technology revolutions. And that's effectively means this FinTech and algorithmic trading impacts the welfare of the people. In another paper that we've shown that I've already mentioned, so they contribute to managerial learning to positively too. Managers looking at the prices now learn more from the stock prices because stock prices are more liquid or more efficient. Okay. Moving on, there's also market manipulation. So I'm trying to take you from one area to another area, right? So once the technology improves, there is new avenues for misuse, and that's also applicable to market manipulators, right? So here I want to explain what I meant by managerial learning in the previous discussion. So when you're an investor, when you're a manager of a firm, you learn from two different signals. One is that you have some internal people, employees, and that basically helps you to make an investment decision. That's what we call managerial information. But managers also look at the stock prices and because stock prices aggregate information of traders, right? So the traders doesn't work for managers. Traders just trade, incorporate information to the stock price, and the managers learn from the stock price, okay? And we have seen that algorithmic trading improves improves this investment sensitivity to the stock price. But then when there are manipulators in the picture too, and the manipulators are continuously utilizing from the new technology, they will be able to add noise into the stock price, okay? More manipulator means stock price is no longer efficient, right? And less efficient stock price means, as a manager, I'm not going to rely on the stock price because I know that they're just noise in the market. So that investment to price sensitivity will decline when there are more manipulators. And we show in the data that actually investment to price sensitivity declines, and that because of that, firm managers have less information and firm future performance declines because of more manipulation in the market, right? So on the one side, we show that algorithmic trading improves managerial learning because algorithmic traders improve liquidity, makes market more efficient, more informative, and in that sense, managers learn more from stock prices. But on the other side, we see that, okay, because of the new technologies, there are manipulators too. They make stock more noisy, and that's why managers learn less from the stock price. Overall, we cannot estimate if managers are learning more or less, but what we can do is zoom in to specific aspect and look how that aspect actually change managers' decision, right? So another thing that is interesting is this, which some of you may be involved too, is retail buying frenzy, right? Back in 2020, there was GameStop event, AMC event. People in Reddit were coordinating together to buy some stocks so that they will skew short sellers. So this was called meme investing, effectively retail buying frenzy coordinated in social media, called Wall Street Bets as a subreddit in Reddit. And then they were just buying GameStop shares, which they called meme stocks, right? Stocks that go viral through memes is called meme stocks. And the idea is that they're going to skew the short sellers, and short sellers will pay the price, because in if you look at the classical financial market models, short sellers are good people, right? So because as a short seller, we think that short sellers are informed, some sophisticated investors that does not let the price to go beyond the efficient fundamental level. But short sellers are also manipulative, predatory investors, because if I'm a short seller, what I will do is I will just present rumors to the market that some company is doing some fraud, but in fact the company is good because I'm just short selling that company. I just want to make profit, so that's why I'm providing incorrect information to the market. Okay, so the aim of this meme investing in Wall Street Bet was to actually skew those bad short sellers, right? But there are also good short sellers in the market, and that meme investing will impact both good short sellers and bad short sellers, right? So depending on how you look at it, this picture can be evil or good, and short sellers too. Some short sellers are good and some short sellers are bad. In a theoretical context, what we show that actually meme investing can be a natural remedy for manipulative shorting. And meme investing actually does not harm informed short selling for certain types of firms and market conditions. So people coordinating in Wall Street Bets or Reddit can actually be a natural market remedy for bad short selling, right? But this is only applicable to certain market conditions and firms, which I don't want to get into too much. That's another area that worth looking at, because in the social media is being more and more used for financial trading, and we still don't understand the implications of that for markets. And here it's just one paper trying to look at from the perspective of meme investing. One area that I want to close this session with before taking the questions is the centrally backed digital currencies, right? So we talked about blockchain, we talked about cryptocurrencies, but we haven't talked about CBDC, which is very important, right? At the moment, all these big countries, China, US, countries in Europe, including Australia, that we are in, we are piloting, we're trying to experiment on centrally backed digital currency. So we're trying to create digital AUD or digital Australian dollar or digital US dollar that can interoperate with cryptocurrencies. And also it could be used as a means of payment, and it could be used as a means of transmitting monetary policy to the whole economy, right? At the moment, that transmission is done through banks. But when there is CBDC, central backed digital currency, besides saving costs for central banks, they will CBDCs will be basically helpful for monetary transmissions and also tax collection, right? So Digital Finance CRC, the research center that I'm working with, we have this pilot project with Reserve Bank of Australia that I'm involved directly with. We're trying to estimate that what would be the impact of CBDC, economic impact of CBDC, and the specific thing that we're looking at is atomic settlement. Because at the moment, even though the markets has improved a lot, when you trade, it takes 2 days for that trade to settle, okay? And in the meantime, there is failures. Some traders that wanted to trade now, during that 2 days, they failed to deliver the product that they were supposed to deliver, right? So I'm buying stock A, but after 2 days, I don't receive stock A because the counterparty decided to not basically provide that stock that I was buying, okay? And there are certain measures like clearing houses that tries to make sure that there is as minimal as possible that failures, but still that that settlement failures are there. And for example, US government shows the settlement failures, I think 2 times a month, that what's the settlement failures in the market. But with atomic settlement and with CBDCs and with blockchain, there is no settlement failures, because by the time everything is coded, so by the time you commit to a trade, you cannot pull back, right? So that's what we call atomic settlement. Settlement happens instantaneously, right? So what we were trying to do is basically trying to add a dollar value to each of these categories of this atomic settlement, right? So obviously we know that with this CBDC, there will be reduced settlement failures, right? So what's the dollar value of that settlement failure? And then obviously we don't need clearing houses when there is CBDC, right? Because clearing houses are there to reduce the risk, but with atomic settlement, there is no risk. So that means there is no need for a clearing house, right? And then margin and collateral costs. At the moment, investors have to have lots of margin and collaterals with clearing houses, so that showing the clearing house that they will be able to do what they have to do, right, in terms of financially. So with atomic settlement, that margin and collateral cost is being reduced, right? So we want to understand how much benefit, economic impact is there, and also reduce back office costs, right? At the moment, banks spend lots of money on the back office costs, on trying to trade reconciliation, who has to send what to who. So with atomic settlement and CBDC, that back office costs are gone. Gains from trade, right? So I have already illustrated what we mean by gains from trade, right? Once the liquidity improves in the market, so that means the volume will increase, new people will come to the market, and there will be new surplus for both consumers and producers, for buyers and sellers, right? There will be increased gains from trades, and we want to quantify what that gains from trade is. In Australian context, what we find is that the economic benefit of atomic settlement is roughly around $2 billion per year, but this may change from country to country. But this is still an ongoing topic for developed countries in like US and Australia, and like some countries in Europe. And for example, Switzerland recently has issued digital bond. UBS, specifically UBS as a Switzerland company, issued digital bond to the market, and that settles atomically, right? So this is already happening. So although CBDC is like still at the early stages, we're trying to understand it and whether we should do it or not, or what's the economic benefits there. But some private firms are already gone to atomic settlement, right? So this is another area that is worth watching in the future, and what the impact is, we're trying to estimate those. Okay, and that's why I'm gonna stop, because I think we are exceeding the time limit, but we're happy to take questions. If no question, maybe I can ask one question. So to get
there is no question. Yeah, Ilkin told that there is no question.
That's fine. Maybe I can ask. So now I put my moderator hat on. So I ask question, right? So that's the task of moderator, right? So let me think about what we have not covered. And in that sense, I will ask some question. Okay, maybe Khaled, to you. Now we have discussed how FinTech has transformed the market, right? And also I looked at different aspects, and you looked at different dimensions. Now, we know that financial market structure has changed a lot from like these designated market makers. Now we're in limit order book, right?
Yep.
Where do you think we're going? So we know where we came from. We know where we are. Where are we going? So what can you tell the listeners on like the direction of where the markets are going in general?
I think that we can talk about few main trends. One is that we are going to have decentralized financial markets. I think Inji mentioned this as well, that we will have blockchain-based financial markets. So today's financial markets are obviously centralized because, let's say, NYC or London Stock Exchanges, these are companies. At some point, we will have perhaps decentralized financial markets. That's one trend that I think we are going towards. Second, we now have a lot of off-exchange trading. Effectively, more than 40% of trading are now in dark pools. Dark pools are avenues that, think about this way, I always give that example. You go to buy some stuff from shopping. You go to the shop and lights are off. You don't see what's happening. You don't see which products are available. You don't see the price, but you just keep bidding. Yeah. So that's what is dark pool. And we see that effectively 40% of shares are now traded in dark pools. And the third trend that I would like to mention is about perhaps we need to design financial markets that aim to minimize the adverse effects of high frequency traders that you briefly mentioned. Yeah. So one is like perhaps the British 2015 QJ paper, yes, the frequent batch auctions. So rather than having continuous market, we can have some frequent batch that people keep bidding and get the price. So these three trends, I think, are there. And I'm not sure about frequent batch auctions because I think it has been tested a few times. It's not still clear cut. I have seen some papers that say it is good, some say it is not good. We don't know what's happening yet. But yeah, so we need to address these few points.
All right. Thanks a lot. I think I'm also with you on the decentralized market camp. And I also think that we're going to have fully automated markets where we don't need market makers. So it's not like today's market where like HFTs back off whenever it's not good for them, but it will be more like a fully automated market where we know what happens when they back off. It's all coded up so that we know what that stressful conditions look like. And also there was a recent paper by some of the colleagues here trying to see what would happen to traditional markets like FX or equity markets if they were traded in AMMs, like Inji was describing. If there was a pool for AUD and Australian dollar and US dollar, what would that look like if they were traded in AMM? And they were finding that for some assets, it's good to trade in AMM, and for some assets, it's good to stay in the current market. And I feel like there will be a natural selection. Some of it will come to these fully automated markets because it's better, but some of it will stay in more traditional markets, right? So we'll see. We can look at this in like 30, 50 years time and see if we were off. But I think, yeah. But in terms of the topics that we have covered, I want to thank both of you and also the speaker myself, but not the moderator one, to cover all this broad topic on FinTech, because probably we haven't covered all. There are lots of things that we have missed because we cannot cover FinTech that has been happening for the last 80 years. We cannot fit that to 1 hour or 2 hours. So obviously some we have missed, but I want to encourage everyone who are listening to our talk. You can always reach out to us if you have any question related to FinTech or finance. So Kaladin is in Edinburgh, and if you search his name, it will come up. So Inji is in Sydney, and I'm in Sydney too, though we are in different universities. So you can easily get our emails from internet and reach us if you have any question, whether related to this workshop or any other things that you think we can answer, okay? Thanks a lot for the speakers and for the listeners. And I hope we continue to do this every year. Thank you. Thanks, guys.
Thanks for your moderation, Nihad. Thank you.
No worries. Thank you.